Before we start the next topic, there was a burning issue about the assignment, isn't it? So this is the assignment. This will be posted in few minutes onto the Google Classroom. Then you can go through that. Basically, this is about foreign exchange regimes, exchange rate regimes. Different countries use different exchange rate mechanisms. You may know, they call a fixed exchange rate or a floating exchange rate, whatever you call it. There are different exchange rate regimes. So the assignment is about that. You have to study different exchange rate regimes and write a report on those exchange rate regimes, the characteristics, what are the advantages, disadvantages, what are the institutional arrangement need to have such a exchange rate arrangement, and things like that, and any pros and cons. So, but to limit yourself going into more details, the maximum 3000 words would be enough. Don't go beyond that. It's easy for both of us parties to assess and for you to limit your scope. And please don't copy and paste. You can download from internet. Don't copy and paste. We'll check for all the assignments for plagiarism, not only things in the internet or any other areas. Even you copy from someone else, it will be detected. So don't do that. You can refer all those things, any material. You have to read those and understand, then paraphrase it. In your own words, you have to write the report. Whenever you have a reference, please use proper referencing. So the submission date is 27th June 2021. So you have 4 weeks. So that's more than enough. So don't wait until last minute and say you got office works, suddenly this happened, that happened. Don't come up with excuses. Start it today itself and finish it by 27th, and you can submit it or upload it to the Google Classroom itself, whether it's a PDF document or a Word document. It doesn't matter, but don't upload it as an image. No images. I mean, in a Word document or a PDF document, that can be there can be images included if you want, but don't write it on a paper and take a photo and upload it. Don't do that. So you can use your own format for the document, no restriction, but remember these key points. Any questions?
So what's the minimum word count, sir?
There's no minimum word count.
Anyhow, we have to write below 3000.
Yes, yes. So try to cover most important thing, what has been asked from you. Try to cover all those things, but within 3000 words. I think that would be enough. Even a undergraduate degree or that sort of thesis, it's about 10,000 words. So this is not that sort of a project. So this is a very small project. I think even 3000 is more than enough. Any other question? If you don't have any other question,
So is there sort of any specific format that
no,
is
that's not a,
required?
no specific format. You can use your own words. I don't just when you submit a report, just be sort of professional. Maintain that. Other than that, I don't want that too much fancy and things like that. But submit just a reasonable format.
Thank you, sir.
Anything else?
Excuse me, sir. Good morning.
Yes. Good morning.
So I got a little bit late to log just 5 minutes.
Mm-hmm.
So can you little explain again?
So this is the assignment. Simply,
Okay.
you have to submit it by 27th June. There are some restriction. Maximum word count 3,000. There cannot be any plagiarism. You have to write it on your own words. No copy and paste, or not from internet or any other books or any sources, or not from your friend. And whenever you use references, use proper referencing methods. That's it simply. So you have to submit by 27th June 2021. For any extension, I think 4 weeks is more than enough. Start it today itself and finish it on time.
So this is regarding the exchange rate regimes, or
Yes, this is regarding exchange rate regimes. And
okay, sir, thank you.
one thing I wanted to mention. So same regime, maybe in different sources, may refer or name it as or in different ways. So don't be confused with all those things, but identify the key characteristics and accordingly find out what are the key exchange rate regimes, maybe around 5, 6. Write the report on that. There can be different words used in different reference in different resources. So
Thank you.
to help you, just this is about that exchange rate systems. Pay attention to this. It's about 2 minutes a video. You will get some overall idea about it.
Hard currencies are liquid and commonly used for international trade. For competitive reasons, or to promote confidence, an exotic currency might align itself with a hard currency. This alignment can take many forms, including these exchange rate systems. In a currency substitution, a hard currency, such as the US dollar or the euro, is adopted as legal tender by a second country. Dollarization is the term used when a country like Panama adopts the US dollar, while euroization is the term used when a country like Montenegro adopts the euro. A currency board system is where a government-backed institution agrees to indefinitely exchange the local currency for hard currency, such as the US dollar, at a pre-specified rate. Such a commitment brings economic credibility, low inflation, and lower interest rates. This is why countries such as Argentina and Zimbabwe temporarily adopted currency boards during their financial crises. In an adjustable peg system, the exotic currency tracks a hard currency at a fixed exchange rate, making adjustments in exceptional circumstances to maintain the rate. An example of this would be the Saudi Riyal, which pegs itself to the US dollar. With a crawling peg, an exotic currency tracks a hard currency, but the exchange rate is gradually and periodically adjusted according to a set of indicators to accommodate differences such as respective inflation rates. In a crawling band, the exotic currency fluctuates inside a narrow band around a fixed central rate with a hard currency. The fixed central rate of the band might be adjusted periodically to keep it in line with fundamentals like inflation differentials. Countries aspiring to join the euro adopt such an exchange rate system for 2 years prior to accession to the euro area. With a dirty float, no official commitment is made to any particular exchange rate, but authorities make periodic interventions into the FX market at their discretion. Hong Kong is said to have a dirty float with the US dollar. In a wide band, the exotic currency floats freely against a hard currency within a predetermined broad band over time. A country might do this when it wants to maintain control of its monetary policy, but not at the expense of its competitiveness. For example, Tonga maintains a band of plus or minus 5% around a central rate against a basket of currencies. Finally, we have a free floating exchange rate, where the currency is allowed to float freely against other currencies. Such an exchange rate system would be adopted by more developed countries.
So I think you got some idea about it. So note that the deadline is 27th June. So please submit online, either in Word or PDF document. Remember that. Okay. Any other question before we move in?
So to whom we submit it?
Submit it online through the Google Classroom. When the assignment is created in the Google Classroom, there's a link that you can submit through that.
Okay.
You can upload the document. Anything else? Any question on what we discussed so far? If not, shall we start the new topic?
So this is belongs to which module, sir?
Which one? This topic?
Yeah.
This is still we are on the first module, the financial markets. Within that, we are discussing different financial instruments and markets. So basically, this is also into the foreign exchange market.
Okay.
Once we finish this, we'll move into fixed income securities. So today we are going to discuss what are the factors influence to the exchange rate. So basically these things, macroeconomic factors will have influence on the exchange rate. When we say macroeconomic, that are the things that will have an impact or show the status of an economy as a whole, not in an individual sector or a company, but as a country or as an economy. What are the measures and how do we gauge with the changes of these, how what is the impact on the exchange rate. So there can be many macroeconomic factors, but basically today we are going to focus on these, on the macroeconomic side. So differentials in inflation in a country. Inflation is a very important factor, especially when we talk about interest rates and exchange rates. So differentials in inflation, it's not just the inflation, remember, it's the difference. What does it mean? Because in a foreign exchange market, there are two currencies. So for the exchange rate, there should be two currencies. What is the exchange rate between those two currencies? What is the rate of one currency in terms of other currency? So the inflation, how it would impact, what is the difference? What is the exchange rate of, what is the inflation in one country and what is the inflation in the other country? What is that difference? How would that have an impact on the exchange rate? That's we are going to discuss. Then the interest rate. Two different countries, there can be two different interest rates. Again, how that will have an impact on the exchange rate. Then the investment opportunities. Now, with the globalization, most of the countries, they don't have any restriction. They can freely move their capital from their own country to other countries. So investors invest in global markets. That means in different countries in different currencies. What are the opportunities? What are the factors that would have impact to take such decision? That will drive the foreign exchange market as well. Then government fiscal policy and the monetary policy. What's the fiscal policy? Basically, what's the government budget, status of government budget. Then the monetary policy, most of the countries' monetary policy is conducted by central banks. How a particular country maintains interest rate or money supply to control inflation and interest rates, that is monetary policy. Then ultimately, trade account, current account, whether it's a deficit or a surplus, that will have an impact on macroeconomy or impact on foreign exchange rates from the macroeconomic perspective. So we'll go one by one. Differentials in inflation. First, we have to identify what is inflation. Can someone tell me what is inflation?
The percentage of increase in price levels.
Percentage of increase in
Price level.
price levels. Okay, say, what do you mean by price level?
So there is a basis which is decided, I think.
Yeah, when we say price level, it's not a price of a particular good or a particular service. As a whole, considering a basket of goods and services, what is the price of that basket of goods and services? We call it the general price. So what is the rise in that? Oh, that's the price level that we are considering. So assume price is 100 at time 0.
Declining purchasing power.
Yeah, when the inflation is there, purchasing power will decline. So we'll try to understand that. When time equals 0, price is 100. After 1 year's time, the price is 102. what is the inflation? What is inflation in this scenario?
2%.
Sorry?
2%.
2%. Yeah, correct. That is the percentage change increase in price. So in time equals 3, after 3 years, say it's 105. Now what's the inflation? What's the inflation during this year?
2.9.
2.9 maybe. I didn't calculate it, but I assume this is correct. Yes. Yes. This is 2.9. So this rate is increasing. 2%, 2.9. Then we call increasing. Inflation is increasing. Remember, it's not the price increasing. When inflation increases, price increases at a higher rate. Clear? What is inflation here?
So there is a deflation of 1.9.
1.9 minus. So when the inflation negative, we call it deflation. So when we have deflation, price level started to decrease. Whenever we have inflation, price will go up. We have to understand that. So the inflation is the rate at which the prices are going up. So whenever we have inflation, prices will go up. Even though inflation goes down, still prices go up. Say if I change this to 106, what is inflation? Maybe 0.9 something, no?
Point 9.
0.9 something, yes. So what has happened to inflation? From first year to second year, inflation has gone up 2% and 2.9. Prices 100 to 102, 102 to 105. Prices are also going up. From third year to fourth year, inflation, what happened? Decrease. But the price increase. So but at a lower rate. That is inflation. So you have to first understand this, not because of you are following this course, or not because of you are working at a bank, or not because of any of those reasons, but because of you are a person in any country. You should know what is inflation. If you don't understand this, then only all those issues come. Politicians will take you rights. You should be able to understand what is inflation, isn't it? Okay, what are the repercussions of inflation? Do you like to have inflation, Oh no, not. Is inflation good?
There should be some level of inflation, right? I mean, desirable level of inflation.
Yes. It should not be too high, or especially it should not be a deflation. Now, you might know in Japan, the inflation is very low or negative. There was a decade of deflation in Japan, so economic growth is very low. So economy won't move. There will be problems in such economies. So there should be acceptable level of inflation. It should not be too high, but most importantly thing is it should be stable. It should not vary, volatile. It should not highly volatile. What would happen if the inflation changes frequently, or what are the benefits of having a stable inflation? Why do we prefer to have a fixed or a stable inflation level?
Business can forecast accurately.
Exactly. So business, they can forecast accurately what would be the price level next year, 2 or 3 years after. So it will give a confidence for the investors to make investments, do their pricing and things like that. So therefore, that's the advantage of having a stable inflation. Sometimes it may be high, but if it is stable, they know then what to do, rather than going up and down very frequently. Okay, if it is the case, how could that affect the foreign exchange rates? Can you think? Inflation in two different countries, how could that affect to the exchange rate between those two currencies?
Local currency is stable against other currencies. I mean the strong, not stable.
When
When the inflation is stable level, at a stable level.
yes, say when our inflation, say Sri Lanka, when inflation in Sri Lanka is stable, our price levels are remains at a or grow at a constant pace. We know that. So price levels are also we said stable. So when the inflation is stable, our country, so that's good. But what about the other country? Inflation of other country, say Sri Lanka and US. We have a stable inflation, but if it is not in the case in US, what would happen to dollar rupee exchange rate? What would be the impact? So as I mentioned, remember, it's not only the inflation what matters, it's the differentials. That means the difference between inflation in two different countries. So when one country has high inflation and other country has low inflation, what would happen? The prices of goods in the in the country with high inflation will go up at a faster pace. Clear? When the inflation is high, say we say country 1 and country 2, inflation is 5% and inflation is 2%. Say at the beginning, price is 100 in both countries. What would happen after 1 year's time? Price of the country 1 would go up to 105. But in the second countries, the price is only 102. Now what would happen? In this scenario, what would happen?
The purchasing power reduces, sir.
Purchasing power reduces where? In both countries,
C1.
in both countries, purchasing power reduces because there's a positive inflation. So, but in the country 1, it reduces at a higher rate. Country 2 reduces at a lower rate. That's
High
true.
level.
So, country 1, purchasing power reduces. But what would be the reaction of the general public or the consumers in this country?
Exports of C2 will be expensive. Imports of C1 will be cheap comparatively C2.
Sorry, I didn't get that. Export of C2 would be expensive.
Imports to C1 will be cheaper. Imports to C2 will be expensive.
Yes, I think what I'm trying to say. So now, people in first country, C1, they see the same good to buy, they have to pay 105. But if they are going to buy it from the other country, the price is only 102. So there may be transportation cost and all those things, but still C1 may find it's cheap to buy from C2. So then what would happen? There will be exports from country to C2, or C1 will start to import goods from C2. Is it the thing that you try to explain?
Yes, sir.
Yes, that's true. What happened? You buy from the country where you can buy things at a cheaper price. Even after incurring transportation costs and everything, if you still manage to get it at a cheaper price, say even at 104 here, all inclusive, you tend to buy from C2. So that would happen. So country with a low inflation become more competitive in the international market, in the sense of trade, providing goods and services, because their prices are relatively low to the compared to other countries. So that's why, okay, now what happened when you export more?
Inflation level further go down because of the excessive foreign currency reserves.
The thing is that's the thing. Forget about the inflation part. What would happen to inflation? When your export increases, what would happen? There will be foreign currency inflows. To which country? In this example,
C2. Right?
C2, foreign currency inflow of C2 will go up. When there are a lot of foreign currency inflows, what happened to the exchange rate?
Getting strong.
Becomes stronger, exchange rate appreciate, or the currency appreciates. That's why it says in this sentence, the currency of a country with low inflation tends to appreciate over time. Did you get that? How this can happen? When a country has low inflation compared to another country, so the exchange rate will appreciate of the country which has a lower or low inflation. Currency becomes strength because price level are steady. So prices are low compared to the other country. So there will be demand for goods, increase exports. That will increase foreign currency inflows and further appreciate the currency. That's what happens. So this is how inflation will have impact on the foreign exchange rate.
Sir, now in Singapore, annually they distribute their country's profit in the public. Is that one? The action they have taken to increase the consumption in the country and maintain the inflation level. Is that one action?
Okay. Yes, simply if you have more than enough money, so to meet your day-to-day expenses, you have enough money. So that's bare minimum. You need money to meet your day-to-day expenses. Then what would happen if you have more than that?
We'll go for non-essential goods.
You go for non-essential goods. What does it mean? You consume more.
Yeah.
Even you were at the below minimum requirement. Whenever you get that money, what do? You increase your consumption, at least partly. You may invest part of it, but at least partly there will be some portion moves into consumption. So then the consumption goes up. When the consumption goes up and the investment goes up, production goes up. So that especially when the consumption demand is there, what would happen? It will create a inflationary situation because there will be more demands for goods. When the demand is high, if the supply won't increase to meet that, price will go up. So that there will be inflation. So, but if the inflation level of a particular country is at a lower rate than what they desired, then they should generate some inflation to bring it back to the desired level. So these sort of things are implemented by different governments, even in US asset purchase programs and things like that. All these stimulus packages, what do? They distribute money or make available money to the general public, so they can start business, they can consume, so that will pick up the economy. Even in Sri Lanka now, what happened in after 2020, not even 2020, even 2019, after his attack with the negative sentiment, some programs were implemented to give more money to the general public and boost the economy. So most of the countries these days, they are doing this. Anything else? So shall we move forward then?
Okay, sir.
So this is a good example. This is the exchange rate between Japanese yen and US dollar. This white color graph, this shows exchange rate. You know how to quote dollar yen exchange rate, whether it's a direct quote or indirect quote. How do you quote dollar yen exchange rate? Is it a direct quote or an indirect quote?
Indirect.
Indirect quote. What is an indirect quote?
The base currencies other than the USD.
Base currencies other than the USD. So the definition of indirect quote is, okay, fine. Then how do we quote dollar yen? So if it is indirect quote, what should be the base currency?
JPY, sir.
JPY. Are we quoting dollar yen in that way?
USD JPY.
We quote USD JPY. That means dollar is the base currency, JPY is the counter currency. So we quote the price of a $1 in terms of Japanese yen. So when we say exchange rate is 110, what does it mean? $1 equals to 110 Japanese yen. That's how the international market quotes dollar yen exchange rate. That's why it says dollar yen. Then you know dollar is the base currency, yen is the counter currency. It is there when we say it's dollar yen, or we call euro dollar. Then euro is base, dollar is counter currency. So it is an indirect quote. Dollar rupee. Dollar is the base, rupee is the counter currency. So we know that. Okay, yen is quoted as a direct quote. Then what does it mean when the exchange rate goes down like this? Which currency strength? When the exchange rate in dollar yen goes down from 122 level to 85 or 70, or maybe 85. What does it mean? Which currency has strength?
Yen is strong.
Yen become strong. Okay. So so during this period, say around from 2002 to 2011-12, though there are some other way movements in the exchange rates, there are reasons for the even to these. The general tendency is to yen to appreciate or strength. The reason you can see these two lines. What are those? Those are the inflation rates in US and Japan. This is the inflation rate is in US. This line is the inflation in Japan. Until 2008, 2009, there was a clear gap. After the crisis only, both comes to a closer level or close to zero. Then again, US inflation started to increase. You can see exchange rate appreciation in terms of yen. So this is a good practical example how inflation would have impact on the exchange rate. In between that, so why this uptrend there? What is the reason here? There are reasons other than inflation. And remember, other thing, whatever the factors that we are discussing here, they all contribute to the contribute in deciding the exchange rate. You cannot take one at a time and consider those. Different factors will have influence in the exchange rate to move in different ways. So what is the net impact ultimately? That will decide the exchange rate. But generally, we can know or discuss what are the possible influences from these factors. So the next one is the interest rates. In general, what do we expect? Whenever one country has a high interest rate compared to another country, what would happen if there's free capital movement? If one country has a high interest rate than another, what would happen? If people can move capital without any restriction between two countries.
People would start to invest because they're getting a higher return.
Yes, people or investors, they look for the higher return, but remember, higher return compared to the risk that they take. You get higher return when you take a high risk. So, but that risk should be compensated with the higher return. If it is not adequate, they won't move. But generally, yes, when you have high interest rate, people will or investors tend to move to that. Those are we call hot money. So when a country has high interest rates, that will attract hot money. What would happen when investors start investing in one country? People in other countries start to invest in a particular country. What would happen to the exchange rate?
Local currency appreciate.
Yes, local currency will appreciate because there will be a lot of foreigners, those who bring foreign currency to that country. They want to sell that foreign currency and buy the local currency and invest. They don't invest in foreign currency itself. They have to convert that into local currency and buy that local currency to invest in that country. So there will be a lot of foreign currency inflows and foreign currency selling. And buying local currency. What would happen? Value of local currency will increase. That means the exchange rate, local currency appreciate. So that can happen, but it doesn't mean whenever you have high interest rate in a country, your currency appreciate all the time. So you might remember around 2007, 2008, what was our interest rates?
About 20%.
Sorry?
20%.
Yes. 20, 25, somewhere like that, at least 20%. So does that, or did that have an impact on our exchange rate? Was it appreciated rapidly? No, that didn't happen. It remains whatever the level we had exchange rate, maybe close to 100. It didn't go back to 50s or 70s, even though our exchange rate or our interest rate is 20%, where US interest rate at that time, 2007 to 2008, in between 4.5 or close to 5%. That didn't happen. Why? While investors consider about the return, they think about, investors think about not only return on their investment or their money, they think about return of their investment. Not only return on the investment, return of the investment. That means whatever the capital you put, at least you should be able to take that capital back. If you don't have that confidence, you won't make an investment. So the credit risk is a factor that investors would look into, whether they will be able to take their money back even without a return. So when the interest rates are high, yes, you can get high interest rate, but with some risk. If that risk is not tolerable for investors or not acceptable, still they don't take that risk. So therefore, high interest rate doesn't mean that always the currency always leads to the currency appreciation. It won't happen. Depending on the other conditions and environment in that country, that could happen. But again, go back to dollar yen example. Again, this white color is the dollar yen exchange rate. This is the interest rates in US, and this line is the interest rate in Japan. So you can see in this area from 2004 to 2007, there's a interest rate increase in US. With that, yen has depreciated. This is about, as I mentioned, the peak is in 2007, 5.25. So when the interest rate goes up in US, exchange rate start to depreciate. Now in this, again, you can see interest rate is going down in US, getting closer to Japanese interest rates. Yen has appreciated. So that's how interest rate have an impact on, or interest rate impacts on the exchange rate. What is the relationship between inflation and interest rate?
Positive.
It's positive generally, yes. When the inflation is going up, monetary policy tends to be tightened. That means increase the interest rates. Now you can see what we discuss about inflation and the interest rates. It seems to be moving in opposite direction. When inflation is high, based on what we discussed here, when the inflation is high, currency should depreciate. But when the inflation goes up, interest rate increases. So according to this, when interest rate increases, exchange rate tends to appreciate. But the thing is here, this interest rate sensitivity is very short term, because whenever a central bank increases interest rates today, from today onwards, you can get that interest rates. So very quickly, capital will flow into that. That's why we call it hot money. And same time, whenever the interest rate goes down, they will take it out. But inflation is not like that. It takes some time to adjust the exchange rate. This happens in the long run, but in the interest rate, movements in the exchange rate with the interest rate is very quick. Then other macroeconomic factors, that availability of cross-currency investments. That means investors, they can invest in different countries in different currencies. Now with the electronic platform and the IT technology feasibilities, this has become very easy. You can do it very quickly. Only thing that if you need to do any legal arrangement and things like that to set up the infrastructure, you may have to put some effort and time. Other than that, once you set up that, moving funds is very easy. So there are cross-border investments. Investors, they want to diversify their portfolios. They don't want to invest only in their country or in their own currency. They want to invest in other countries, in different countries, different economies, different currencies, different sectors. Because you know, say whatever the industries available in US may not be in German. They might have different expertise and different industries doing well. So if US investor wants to get the exposure to that industry is doing well in German, they don't hesitate. They will invest in that German company. So likewise, there will be a lot of cross-currency investments or cross-border investments. But to happen that, the key is there shouldn't be any exchange controls. The investors should be able to bring money or take money back without any restrictions. Less restrictions, they prefer those countries. So depending on that and other economic environment, there will be inflows between countries, that will have an impact on the exchange rate. So nowadays, this is a very influential factor. How investors think about other countries, and where what is the tendency to them to buy or diversify their portfolios in two different countries. So I forgot one thing to mention here. In this credit risk, there's a good case study. If you go back, or if you have ever heard about currency crisis, Asian currency crisis, countries like Thailand, Malaysia, or South Korea, Philippines, they couldn't control the exchange rate just by increasing the interest rates, because there was a panic situation. Investors had a doubt whether these countries will be able to pay our money back, and this sort of scenario, this high interest rates won't work. That's a good case study if you want to study more. Better you just at least read what has happened. That has an impact on the exchange rate regimes as well. The other macroeconomic factor is government fiscal policy. What is government fiscal policy? That's about what is government income and what is government expenditures. Whether government income is more than the expenditures, or whether the government income is less than the expenditures. What are the sources of government income?
Taxes.
Basically, taxes. So the government should be able to collect a good tax income to meet government expenditures. What are the government expenditures?
Government salaries of
Yes,
public servants.
salaries of government service, then developing infrastructure, things like that. So there should be enough tax collection to meet that expenditures. If there's any gap, what would happen? That means if the tax collection is more than expenditures, we call it a government or budget surplus. Government income is more than the government expenditures. That's a budget surplus. When you have budget surplus, is it good or bad?
In both ways.
In both ways. Why?
It might reason to inflation.
When the government has a surplus?
Because money supply will increase.
No. How government has more income than the expenditures? How could that affect the money supply?
And they will increase the government servant salaries like that.
But still, it's within the system.
Yeah, then that purchasing power will increase the government sector servants and other employees.
Sorry?
Then that purchasing power of the government servants will increase with the salary increase, or any other income revenues will increase. What will happen? That purchasing power increase, then accordingly that prices of the market will get increased.
Not necessarily, because whenever government has surplus, it doesn't mean the money supply in the system has increased. That surplus, it's just a transfer from one participant of the system to the government. So that's a tax collection. So the money was with companies or individuals now has flown into the government. Still, the money supply remains same. But yes, as you mentioned, if government decides that to increase government servant salary or things like, then there will be small impact on that. But generally speaking, having a budget surplus is good. You will realize that when we discuss about what would happen when there's a budget deficit. When the budget has a surplus, if they manage it properly, they can increase expenditures, doing more projects, developing infrastructure in a proper manner that will come back to the system itself and grow the economy. But when we have budget deficit, what does it mean by a budget deficit?
You need to borrow money from outside to cover the deficit.
Yes, government has less tax collection or less income than the expenditures, so they need to meet that obligations. However, the government has to borrow money, so they issue government debts. What would happen when there are more government debts? From where do you find that money?
Interest rates will go up.
Interest rates will go up. Why?
Government
There's a
need to borrow money from the public.
Yes, government wants to borrow money from the public. If government doesn't borrow, what does the public do with those money?
They can borrow for lower interests.
No, now the money is with the public. What do?
They invest.
They invest.
In people's.
Yes. The public will invest those money, so there will be new business or new industries, something like that. So there will be more production. Private firms, they have access to funds and expand their business or start new business. But what would happen when the government borrowings increases? Part of that money available in the system will flow into the government. Funds availability to private sector will go down there, so interest rate will increase. There are a lot of parties demanding for money. Interest rate goes up. Cost of funding goes up for private firms. They are not in a position to start new business and things like that. So that's why it says less investments in private sector. Not only that, whenever the government borrow money today, they have to pay it back in the future. Then what would happen? Government has to either increase tax in the future or borrow again. Either increase tax in the future or borrow again. So that will have a bad impact. So when these things happen, what would happen to the exchange rate? When there are no private sector investments or no opportunity to do that, interest rates going up persistently, and the government is just because of government borrowing money, then what would happen? Foreign investors won't come and invest in such a country. So foreign inflows will go down, then exchange rate will start to depreciate. the local currency will depreciate. That's what is happening when there's a budget deficit of the government. So the fiscal policy will have an impact on the exchange rate. When the budget deficit is there and it's continuous, persistent, then it's too bad for the currency of that country. The currency will depreciate. Not only that, what are the other policies? Too much high taxes and not use those tax income in a proper investments to generate more income to the government or to the economy. Tax income is wasted. All those things will have an impact on the investment decisions of foreign investors. What are the government policies? Whether the legal infrastructure is there, good, corruption, all those things will have an impact on the exchange rate ultimately.
So in this case, if government borrow from the outside, that means from any other country, then that public debt will not increase. In such a scenario, what would be the position?
Yes, we'll come into that. Yes, for the government to fund that deficit, there are two ways. One is fund locally or fund it overseas. That means borrowing from overseas. If the government borrow from overseas, then there will be foreign currency inflows that will have an impact on the exchange rate at the time of borrowing. But remember, when you pay it back, you have to pay it with interest, and unless you use those funds to generate government income, which will be able to enough to pay back the capital and the interest, what would happen? After a few years' time, government will have to borrow again. Or at the time of borrowing, from where, or at the time of maturity, when they want to pay it back, from where the government is going to find foreign currency. Then there will be an impact on the domestic foreign exchange market, and the exchange rate or the domestic currency will start to depreciate at that point. Immediate impact, yes, it would be appreciation. Then at the time of repayment, it would be other way around, unless government borrows again from the foreign countries.
It's like a rollover process.
It's a rollover process, and it's not good in the long run.
But if the government manage these funds very proper manner with proper forecasting, I think that is the best way of doing, no?
Yes. So, okay, as an individual, you don't have enough income today, or you don't have enough funds today, but you have a proper income. Don't you borrow? You borrow funds. You may build your house or buy something like that, but since you have a proper income flow in future, you can pay it back, no problem. So firms, take private firms, what do? It's not 100% their own capital.
Yes.
They borrow funds, then they use it in a productive manner. They generate an income which is sufficient to pay back their debt, and while making a profit. They generate the income, they pay back the debt with the interest, and they have some excess funds as well at the end. they take a return. So borrowing is not bad. Why do you borrow? How do you use it? That's the thing. If you borrow to just to repay the debt, then it won't work. Say you borrow money, you consume everything, you eat and spend money, and you go on trip and for leisure time. What do you do when it comes to payback time? You have to borrow it again. Can you do that forever?
It's like a postponing, no?
It's like a postponing, yes. On this thing, the government borrowing, either you tax today or borrow today. There's an economic theory called Ricardian equivalent. What does it say? If a government borrow today, which is equivalent to increasing tax in the future, because to pay back that borrowed amount, government has to increase tax in the future and pay it back. What do? You just postpone today's burden to the future generations. That's a good economic theory. If you are interested, you can study that as well. So here our focus is how the government fiscal policy will have an impact on foreign exchange rate. So basically, underlying message is when the government is having a budget deficit, to fund that budget deficit, government has to borrow. That will have an impact on the private sector. Or that means there will be a private sector crowding out. That means the opportunity to invest will be low. That will have a negative impact on the economy, because there will be less production, and there will be that's the thing. When there will be less production from the private sector, there will be less tax collection. If the private sector is not performing well, generating income, government is not in a position to tax them. Even the tax collection would be low. That's the cycle. So that is not good. So therefore, foreign investors will not come and invest in a country. So there will be less foreign currency inflows, and therefore, ultimately, domestic currency will depreciate.
Sir, government can print the money and pay its debts also?
No.
They don't, they do?
How? What is the mechanism?
No,
What does it mean? What does it mean by government can print money?
Means if they have purchased, they have issued bonds or bills, then when they mature, if they don't have money, can't they print and settle that?
No. What does it mean? To that to happen, central bank has to lend to the government. Whenever government issue a new bond or a bill, central bank can buy that. That means central bank is lending money to the government. That's that so-called money printing. So then, when it matures, again, government has to pay it back to the central bank. But only thing is, you can keep doing it repeatedly. In that sense, what would happen? Money supply will increase in the economy. When the money supply is increasing, what are the repercussions?
Consumption will go up.
Consumption will go up. What does it mean?
Inflation.
Inflation. Then If the inflation is high, again, less production, less investments. That's the cycle.
Pressure on exchange.
Less foreign exchange. Yes, from the foreign exchange.
So that happens, no, sir?
That happens, yes. So this is more or less like a economic lessons on economics. So there's a link. Yes, foreign exchange. So we discuss foreign exchange here. It's part of the economics. Even in economics, we discuss about foreign exchange, these factors, how these factors affect the foreign exchange rates, things like that. So we don't want to go into that deep. If you want, you can study that economics from economic perspective. How would these things happen? But at this level, what you should know, what is the impact if this happens. All these are interconnected. Inflation, interest rate, exchange rate, fiscal policy, monetary policy, all these are interconnected in this macroeconomic environment. Shall we move forward?
Excuse me, sir.
Yes.
So what are the sources that central bank support for the government debt?
What are the
Sources like other than the money printing? Are there any other sources we support for the budget deficit, government debt to cover up?
There's no other source per se. I'm not sure what is your question. So only thing is there are few provisions in the MLA. Say when the what do you call this budget? What we call budget, when the budget is approved. What is called some act? No, it's not a. It's act. Every year they approve that act. That's what we call budget. I cannot. The word, it doesn't come to my mind. So when it approves, there's a percentage at the beginning. If it is a deficit and there's a budget requirement, part of that can be funded by the central bank can give as an advance, say 10% of the budget deficit or something, borrowing requirement. Initially, central bank can give as an advance. But at the year end, again, there's a provision in the Monetary Law Act. From the profit of the central bank, once we allocate those to our build up central bank reserves and things like that, if after doing that, if there's any excess out of that profit, again, a certain percentage can be transferred to the government. You do that after deducting that advances already made. That is the mechanism available in between. So that's the way that central bank purchase these government bonds. So basically, central bank does not buy bonds from the primary market, only the bills from the primary market to help the government. That's the basic mechanism available. Other than that, to my knowledge, there's no other way that the central bank can give money to the government. And remember, even most of the bankers at high level, they couldn't understand the government and the central bank are two entities. If central bank borrows from a foreign party, that fund would not be available to the government. There's no way to give that money to the government. If government borrows money, then that funds will be available to the government. Any other question? Any questions? Any questions, please? No. Sorry, someone is trying to ask something. Or
No questions, sir.
no questions. Okay, shall we move forward? So then the monetary policy. Monetary policy, there are two ways. One is indirect intervention. The other one is the direct intervention. Indirect intervention comes through the controls of money supply. So I think we discuss about open market operations. Through open market operations, central bank can influence the availability of money in the system, either increase the money supply or decrease the money supply. So as we discussed earlier, when there's too much money, what would happen? That would create inflation that will lead to weaker currency. That's the basic underlying message there through indirect intervention. Central bank can influence on the exchange rate by increasing money supply or decreasing money supply. When central bank increase money supply, then the inflation goes up and the currency weakens. If the central bank absorb money, that means lower the money supply, then the inflation will be, or at least it won't go up or remains at the same level, or maybe inflation come down. Then it will lead to the currency appreciation. In the direct method, direct intervention, central bank directly go to the market, foreign exchange market, and either buy foreign exchange from the market or sell foreign exchange into the market. Then there will be a direct impact on the exchange rate, immediate impact. But in the indirect intervention, it takes time to go through this impact. We call it monetary policy transmission. In Sri Lanka, it has estimated about 2 years. So if the central bank increases interest rates today or decrease money supply, to transit it to the lower level of the economy, it takes about 2 years, because there are a lot of delays in the system. Say now, what is the SRR requirement? 2%. What are the policy rates? What are the policy rate now?
4.5 and 5.5.
4.5 and 5.5. But is there any customer of you still paying maybe 12-13%, even though they have borrowed at a floating rate? Yes, there are lags. It takes time to reduce the interest rates at the lower level of the economic participants at the lower level. There are frictions in the system. So therefore, to flow that into the economy, whatever the monetary policy impact, it takes time. So therefore, indirect intervention, you may not see immediate impact on the market. But exchange market is very sensitive. Whenever they see the policy change, they know that So this would happen. Therefore, the market would react quickly even to the indirect intervention. But direct intervention, very obvious. Central bank is buying from the market, then the exchange rate goes up, or the local currency start to depreciate. On the other hand, if the central bank sells foreign currency into the market, immediately there will be an impact on the exchange rate. Domestic currency will start to appreciate immediately. But to do that, especially to sell foreign currency in the domestic foreign exchange market, central bank requires significant amount of foreign currency reserves. Without ample reserves, central bank is not in a position to especially sell in the market. They can buy and build up the reserves, but to sell, there should be enough reserves. But meantime, whenever the central bank buy or sell foreign currency, that will have an impact on the domestic money markets as well. Whenever central bank buy foreign currency, what would happen? There will be money supply. Because when central bank buy foreign currency, central bank inject rupees, pay rupees and buy foreign currency. So the money supply increases. On the other hand, when central bank sells foreign currency goes out into the system and domestic currency goes out from the system into the central bank. Then the domestic currency availability, money supply goes down. Then there will be an impact on the interest rate. Interest rate will increase. Foreign inflows will be there. The exchange rate appreciate. That can happen. Any question?
In the previous slide, the too much money and inflation going up is the relationship between the buying power and the increase of goods, prices of the goods, no? Direct impact of those two, no?
Yes, whenever there's too much money supply, what would happen? People will tend to consume.
Yeah.
Or investors want to invest. Then there will be a demand on capital goods or the consumption goods. But you cannot produce those immediately. Then the price level goes up.
Right.
That means inflation.
Both have the positive relationship. When there is more cash, the prices do the goods prices go up. That's why
Yes.
Direct.
Yes. And the trade and current account. What's the trade account?
The export and import.
Basically exports and imports. So trade account deficit means we have more imports than exports. Trade account surplus means we have more exports than imports. That's surplus. Okay. Whenever there's a deficit in trade account, what is the difference between trade account and the current account? Is there any difference? Indeed, current account is the main one. Current account and the capital account are the two major portions of the country's BOP. Part of current account is trade. Whatever the income or expenditures generated through trade, but there will be other current transactions or transactions in current nature, maybe interest income, interest expenses, worker remittances, in or out, things like that. Those are falls into the current account. Trade account is part of the current account, but generally speaking, major portion of the current account comprise of the trade account. So whenever the trade account is at a deficit, that means we have more imports than exports. Generally, current accounts also is at a deficit. So what is balance of payment? For a country, at the end, whatever we pay, we should have received. So the balance of payments or payments, capital account and current account should be, at the end, balances should be zero. No flows, no outflows. That's the general concept. So whenever there's a deficit in the trade account or the current account, what would happen? That will be balanced through the capital account. That means to fund that gap in the current account, we have to borrow from overseas. Then there will be capital inflows, either borrow or bring some long-term capital investments. We can use those inflows to bridge the gap in the current account. But on the other hand, if you have surplus in the current account, what do? We make investments in overseas. Then the capital account becomes negative. But ultimately, balance of payments is at a balance level, zero. So as it says, current account deficit counterbalance by a surplus in capital account. So that's what I explained. When the current account is at a deficit, there should be some flows into the country through the capital account. How do we achieve surplus in capital account? If there's not enough capital inflows for investments in the country, this is the way how we can achieve. Either by selling government debts to foreigners or assets or countries' assets to foreigners. So this is the reality. That's what we are facing now, whether we like or not. That's the reality. So now in the current situation, selling government debt to foreigners is not the optimal option, or not in a possible, or it's not possible basically at this stage. So the only option is sell assets to foreigners to bring foreign funds to do what? To bridge the gap in the trade deficit or the current account. What do we do through the current accounts? We import goods and basically goods and services, and we consume. So this is very similar to what I explained earlier. You borrow money, you just consume, no savings, no investments, nothing. You just consume as an individual as well as a country. That's what we are doing. We don't see any consequences of that. And either we don't want to see that, or even the people, those who see that, they ignore it. That's my reading. So think about this. Whether we are, and decide whether we are moving in the right direction. Okay, now our concern is what would be the impact on the foreign exchange rate or the exchange rate. When we have trade surplus, That means more foreign income, that it is good, the exchange rate will appreciate. When we have a trade deficit, there will be outflows. So the tendency to depreciate the currency. But since it is balanced through the capital account, it will set off. But the problem comes when there's no even the capital account surplus. If there's no capital account flows and the current account is deficit, how do we fund it? Then exchange rate depreciate and central bank has to use its reserves to pay back our debts or obligations coming through the trade or the current account. That's what happened. So this is a very important component or the factor that will have an impact on the exchange rate. So as a country, you cannot keep the exchange rate at a fixed rate while import goods more than exports and keep the interest rates low. You can't do that. So there's a thing called impossible trinity. That's another part that you may have to think about when you write or answer your assignment. In one of the regime, that is a matter, impossible trinity. So that comes into play. Any question? So that's all about macroeconomic influences.
So selling port city lands at the last moment when the reserves are very low, it's a disadvantage for the country and it's not attractive for the investors, right?
That depends. Whether we are selling that at when the reserves are low level or not, that's a different story. The thing is, okay, what is this land? What is the intention of that land and why do we have to sell it? Is it just purely because of we need money now? Or
yes,
is it so
we need quick money?
We need quick money. That's true. Okay, even we don't want quick money. Okay, this is a business. Can the government run business? So what has happened to all the state-owned enterprises other than banks? Which one is making money? If you take Sri Lankan, when it was under Emirates, it was profit making. After that, what happened? So CPC, CEB, Railway, all those things. What's happening there? Those will add to the people or general public pocket. We are paying tax to make those losses. I don't know where to go those funds. So in that sense, I think the responsibility of the government is to put up the infrastructures, proper infrastructure, like building highways or things like that. But more importantly, we need the other infrastructure, legal and things like that. The government authorities, they should be able to work very efficiently. give whatever the approvals need in a quick manner without having bribes and corruptions there. That's the thing the government should focus. Set up that infrastructure. You will see there will be a lot of inflows into the country. And will you just give some money to anybody free? No, you need some return. Investors, they come only if they have return. Otherwise, they won't come. So my personal view is, whether it's selling or leasing, all these are different jargons they are using. Whether I don't know whether it's for foreigners or local. If we have local, we should allow them to do the business, not by the government. And the other thing, whatever we do, if we don't generate adequate income, we won't be able to survive. We won't be able to pay back these things. Okay, so you might have seen local families, maybe decade ago, they had a lot of lands and the houses, they call, say, Walauwa and things like that. What happens to them? They just do nothing. They sell small plots of lands and consume. Only few manage it properly and improve their lifestyle or develop. Others, what has happened? Go bankrupt, and now they are maybe the poorest people in the village. Have you seen such people? That's exactly what happened in Sri Lanka. We have to work, we have to produce goods and do things like that. We just import and consume. Without generating any income or producing anything and sending it out. And the other thing is, you can't do that overnight. You need some long-term policies, consistent, not every 6 years changing this and that. You need consistent policies. Okay, we are talking about exchange rate. Would you prefer to have the exchange rate is 200 or 100 rupees? Which one you prefer?
100.
100. Why? What's the benefit that you get?
We can import goods at cheaper.
That's why.
Import
You want to import and eat, consume.
Not
It won't work for the country.
Exporters' point of view, it is not good, no?
It's not good. So if we want to develop the country, we should encourage, see the policy inconsistencies. Always we are talking about, we are promoting exports. But meantime, what they said, we'll manage the exchange rate, we want to see the exchange rate appreciation. It won't happen. It won't happen, and it's not good for it's not consistent with the policy. If you want to promote export, you should let the exchange rate to depreciate. And so that's the competitiveness. Then only our goods and services are cheap in the international market. Then only foreigners will buy our goods. But you can't do that overnight. But because in current situation in Sri Lanka, we heavily depends on import goods. So therefore, you can't let the exchange rate to go to 300 or whatever it is immediately. Then the cost of living will increase, and there will be unrest in the country. While you are controlling that, you have to build up the capacity to produce goods and services in Sri Lanka and export it. You can't do that overnight. So the people think low exchange rate is good. It's not the case. So if you go back to one of these slides, this dollar yen, I said that there are reasons for this sort of movements. What is that? Japanese government and the central bank deliberately brought policies to prevent the appreciation of exchange rate. Why? It is not good for their exporters. They want to maintain at its around 120 or somewhere like that. That's their preferred range. They try to minimize the chances of appreciation. The same thing is done by China. So what's the fight between US and China? US always saying that China is not letting their currency to appreciate. They keep it at a artificially at a depreciated level. Why? To get the trade advantage. That's why China imports more goods to US. So US people find it cheap buying from China. That's what happened. It's not just keeping the exchange rate at a depreciated level. You need other things as well. So market sentiment. This is apart from macroeconomic factors that we discussed. Considering all those things, what is market view on the exchange rate? That is what we call market sentiment. If I ask what is our market sentiment now on the exchange rate, dollar rupee, what is that?
It's very much negative.
It's very much negative. Market participants, they think rupee will depreciate. So that's the sentiment. Why? Most of the macroeconomic factors that we discuss, they are giving us the signal that our situation is not good. Rupee should depreciate. So that is market sentiment. So when market develop their sentiment, all those factors will be considered and factored into the factored in when deciding the exchange rate. So sometimes market participants may do those things consciously or subconsciously. You might see even now some answers. So the way that you predict, you don't know what's happening, what should happen, or things like that, but we think, okay, this will happen, currency will appreciate or currency will depreciate. And maybe some of these due to their own positions, what they desire, things like that. And the economic statistics also will have an impact on the market sentiment. When we say economic statistics, most of the macroeconomic factors that we discuss, the announcement of those economic statistics. If we are going to release the inflation figure next week, then the market will have an view on that inflation figure. With that, market sentiment will build up. If inflation goes up, this central bank may increase interest rates. Therefore, there will be a positive impact on the exchange rate. So the positive sentiment, something like that. So unemployment rate or the employment rates. If the unemployment rate is going up, it's not good. Not like countries Sri Lanka. Developed countries, they use higher rules. That means whenever they have business, they hire people. Whenever they don't have business, they fire people. So therefore, economic conditions will be very much reflected in the unemployment rate. So in a country like US or UK, those developed countries, unemployment figure is a very, very sensitive figure. The bond market and the exchange market moves very quickly when they release their unemployment figures. That's the most volatile minute or few minutes in the global financial markets when the US announces their payroll figures. So likewise, the economic statistics GDP figure, what is GDP, whether GDP is growing at a good rate or not, whether it's a downturn of economy, that means whether we are in a recession or not. All those things factors into the market sentiment. In market terms, sentiment we call we use two different words: bullish market and the bearish market. What is bullish market? That means we think currency strengthen. In the bullish market, we think the currency strengthen. In the bearish market, we think currency will weaken. So when the numbers and things are negative, market sentiment would be bearish. When the things are positive, when we see rosy pictures, the market sentiment would be bullish. That will have an impact on the supply and demand of currencies, and that drives the market sentiments, that drives the exchange rate pretty much. So sometimes you might see even the numbers are coming out very positive, but the exchange rate moves other way because that supply and demand and the market sentiment for whatever reason, market sentiment is negative or bearish, even though the figures are or the economic numbers are good. There are a lot of speculators. They speculate in a particular direction. They can drive the market. So when you are in the foreign exchange market, you should have good sense of things, what's happening around you. The other thing is world tension. If you can go back and see what would be or what were the foreign exchange rate movements during last month when there's a tension build up in Middle East area due to Israel-Palestine issue, you might see there's a price fluctuation. Whenever the world tension level increases, there are few currencies called safe haven: US dollar, Swiss franc, Japanese yen. Those currencies will tend to appreciate when the market is unstable. The safe haven currencies start to appreciate. These tensions may be not only war or maybe other people unrest or things like that. Speculation, as I mentioned, the foreign exchange market now broadly driven by speculators. They just want to make money quickly, so they drives the market. The other one is the event risk. When we call it event, it can be any event, maybe a natural disaster, political event, or economic disaster, wow, whatever, that will have an impact. But remember,
question.
Yes.
Can the speculators manipulate the market?
What do you mean by manipulate?
That means they even the trend is to be appreciate the local currency. If we say, can they say it's going to depreciate and make profit?
Yeah, that depends. The manipulation word comes, I think, in the context. What is the exchange rate environment or the regime in that? Say in a free float market or with less restrictions, as I mentioned, exchange control restrictions. If there's no exchange control restriction, anybody can buy or sell foreign currency. In that market, if a speculator wants to drive the market down, what he can do, he can sell. If he has enough funds, enough money, he can keep selling. Then the market will go down. You can't stop that. But in a controlled environment, if you do something without your underlying transaction, or there's no way for you to justify this would happen, so then you can consider it as a manipulation. That's my reading on that.
So that happens in some countries, in Sri Lanka also.
It is that because that's why we have some restrictions. Not everybody can participate in the foreign exchange market. Not everybody can buy. Not everybody can sell. There are restrictions. If you do some transaction without that restriction, or players, those who have money, somehow they drive the market, then that can be considered as manipulation. But if the market is big enough, there are a lot of players, even the speculators, they won't be able to do that without taking a risk, because you never know whether your amount of sales would be enough to drive the market. There may be another player who is having more money than you. When you sell, that party will buy to get the advantage. He wants to drive the market up. You want to drive the market down. There will be a competition. Those who have more power or more flows can drive the market. But basically, there are norms, and the dealers and the market participants, they behave in a manner they have their set of norms, and they don't try to manipulate. That's true. But speculators, if they have funds, they can drive the market. There's nothing to stop them. But to do that, it should be a free market without any control. Did I answer the question?
Okay, thank you.
We were talking about disasters. Oh, sorry, event risk, different events. That can be positive event or that can be negative event. So it can be natural disaster, political disaster, or economic revolutions, war, or whatever. Okay. Natural disasters. What do you think? If a natural disaster happened in a country, what would happen to the currency of that country? What is your call?
Depreciate.
Depreciate. Any other view?
I would say it will initially depreciate, and on periodically it will appreciate further.
Immediately depreciate and periodically appreciate. Okay. Can you explain why the currency would depreciate?
The moment that there is a natural disaster, when you take the tsunami for an example, like, there are a lot of funding has to be made in order to do the basic things. So after that, we have got some donors, and all these World Bank and ADB started funding us, which means we got more funds to the system, foreign exchange. So that's what I was just telling, that initially we may depreciate and gradually may depreciate.
Yes, the thing is, what do you mean by initially? what sort of time frame that you referring, but yes, my view is like the moment in the first few minutes, so yes, in that it will depreciate, but when you take about at least 1 year period, very short term would be appreciation, then maybe depreciate. The maybe within few minutes, with few seconds, yes, it may depreciate. However, that depends. You can't have a exact rule on that. That depends on the country and the nature of the disaster and things like that.
Impact of the event, right?
Yes, in a way, impact of the event. Not only that, the way that you have positioned before that, I'll give you a few examples. Even this picture, 9/11 attack. So you would expect, what do you expect when there's a terror attack in New York? What do you expect?
Actually, it's a disaster for USA that world thinks that like that.
So then dollar should
Anyway,
be,
they have recovered because that they have enough reserves and like that. Even in this pandemic also, they have recovered very well.
yes, no, even the very short period, what should be the impact? Whether there
Depreciation of that.
depreciation, but it's not the case. When the moment there's an attack in US, dollar start to appreciate. That's what happened. Because as I mentioned, that's a safe haven. Initially, people think, okay, something wrong somewhere, the risk is increasing, we should go back to the safest asset. So they believe US, they will never default. So they take all the investments in other countries back to US. They park money in US. That could happen. So I'll show you a few examples. Later I'll show. So news of potential events in the market, there may be a lot of rumors, this is going to happen, that's going to happen, and things like that. All those things will factor into the exchange rate. Whether positive news will drive the market up, or that means towards the currency appreciation, and negative news will drive market down for the currency depreciation. So that's why foreign exchange traders, they don't take their eyes out from the screen. They always watch the screen, reading news, what's happening. Because the moment you just take out your eyes from the screen and come back, then some event might have occurred somewhere in the world and the market has moved. If it is in your favor, that's good. Otherwise, you lose. So a lot of events can happen, natural disasters, maybe earthquakes, tsunamis, or floods, or anything matters. So because even two big companies merge in two different countries, then there will be big capital flow from one country to another. So that will have an impact, or the whole paradigm will shift into a different scenario. If a big company fails, what do you think now if they announce Google bankrupt? Definitely US share market will crash. Then what would happen to the exchange rate? What would happen to the foreign investors, those who have invested in those? And if Google fails, what would be the reading of the investors? Will they take their money back to US, those who have invested in other stock markets in other countries, what would happen? So all those things. Central bank change interest rates. So basically these things are pretty much like, when the central bank is going to announce their interest rate. But so then therefore you can be ready to see what's the news. But if it is happen very quickly, unexpectedly, like this one, this happened in 2008 for the financial crisis. As responding to financial crisis, Fed cuts rates by half point. Generally, they used to change the interest rate only by 0.25%. But at this moment, suddenly they announced they are going to reduce interest rate by 0.5%. So those things can happen. Then the market start to move. Even in 2007, just before, at the very beginning of the crisis, suddenly in August, one day, we were watching the screen, we can't see anything, but all currencies started to depreciate, dollar appreciate. Then we try to find out what's the reason. Then only we find out something has gone wrong. In BNP Paribas, one of their funds has closed. They are not going to pay that. That's one of the triggering event of the financial crisis. So all the economic numbers were positive, but all currencies are depreciating. What happened at that point? That's another good thing. That's another event. BNP Paribas, that's a Paris bank. They find difficulties to pay their investors. Reason is they have investments in US mortgage sector. But the initial reaction of the market is dollar appreciation, other currency depreciate, thinking that there's a problem in Europe banks and other risk countries, other countries. So they thought the best thing is to go back to US. But with the time only, after 1 year, like when the Lehman Brothers bankrupt and things happening, then only they realize, not in 1 year, maybe 1 month or things like that. Then only they realize the problem is not in other countries, problem is in the US. Then only the exchange rate movement started to reverse. Dollar depreciate, other currencies appreciate. That's why even sterling pound went to more than 2, Australian dollar went more than 1, things like that. So very sensitive to this event. And how do you, what is the information set available, how the participants react to these numbers or the events. That is very important. You have to be very careful, watchful, and pay attention what's happening, what would be the consequences. So yes.
Now the Federal Bank of America is the institute that print US dollars. So in this kind of scenario, can't they manipulate their figures and attract their investment outside the country to the Sri Lanka, US? Because their money, USD is their money, can't they print US dollars and manipulate the figures?
Okay, what would happen? They might manipulate or print dollars.
Excess funds to the market.
Then what would happen?
Inflation again.
Inflation. So the thing is, now with this pandemic, what happens? So it's negative to the economy. For any central bank, what should they do? Give some boost to the economy. So that's what they did even in 2008 or 2007, 2008 financial crisis. Even after now in this pandemic, that's what they are doing. Basically, they print money, give money to the public, asking them to consume and boost their economic activities. Then only the economy can recover. I don't think whether we can say it's a manipulation, but that's a thing that they should do. But the most importantly, in US, most of the relief packages, they are not coming through the Fed. Most of them are funded by the government, Treasury. Funded by government, they implement it through Fed. That's what happened. If they give credit to some parties, the funds are provided by the central bank, government. Then it will go through the Fed. Fed do the market operations and provide money. That's what's happening. It's not then it's not central bank money printing. But the thing is, US Treasury, they can borrow at any time. All over the world, there are investors who is willing to buy US Treasuries. But countries like us, it's not the case. So I don't think it's a manipulation. But yes, if you want, it's the biggest market in the or biggest country. If they want, they can do, yes. But there are ways of doing those things if they want to do that.
So my other question is now, China being one of the largest economy in the world, when compared with the other currencies, why the Chinese yuan is behind, and why don't they have a proper platform to transact with their own currency in international trade?
That's what China, they are, what is their policy on the exchange rate? They don't want to open it economy. They want to do it gradually. So therefore, it's not freely convertible. Not anybody can buy and anybody can sell Chinese yuan, because if that happens, there will be a sudden appreciation in Chinese yuan that will have an impact on their export. Then the Chinese good no longer become cheap. That can happen. I don't know. So therefore, they relax it gradually. To do that, what is their strategy? So what they want to first become a sort of reserve currency. Everybody has some obligation toward China to pay in Chinese yuan. Then every country try to keep some part of their reserves in Chinese yuan. Once that happens, they will open it up. Otherwise, they won't do that. That's their strategy. That's why they lend for many countries. Now they may lend in US dollars, but later one day they will say, okay, you have obligation in US dollars. If you don't have US dollars, why don't you pay in Chinese yuan? Then the borrowers obliged to keep it in yuan, and they will start to demand yuan. Things that if you go back and read the history of global exchange rate movements, now the US dollar is the reserve currency, main reserve currency. But there was a regime, sterling pound was the reserve currency, because they had their colonials. All those countries use one way or the other way, they're bound to use sterling pound. So most of the countries keep it in sterling pounds. But with the economic performance and other things, that was gradually shifted towards US. Then US becomes the reserve, US dollar becomes the reserve currency, because US lends to a lot of countries do trades with a lot of countries, then you need US dollars to trade with US, to pay your debts. That's what happening. So now even China, now gradually what they are doing, they are extending their hands or their presence in different areas or different countries, try to influence most of those countries. Once they and gradually release or relax their policy. Maybe if very unexpected event, very serious event happens, maybe in another 20-30 years, China would be or take the reserve currency position. However, so far they have control environment. Not everybody is allowed to trade in yuan, and to encourage export, they don't want to appreciate yuan. So that's why this setup is there. That's what happening there. Did I answer your question?
Yes, sir. Clear.
Sir, I have a question.
Yes.
What is the difference between yuan and renminbi?
Both are same.
Same name.
Yes.
Why there are two names?
Renminbi, I think renminbi is the official name. Yuan is like a pet name, if I remember correctly. Yes. Say dollars. Okay, sterling pound. Those who in the market, if you want to buy, if you want to buy pounds, what do you call? Cable. You don't call pounds. You ask 5 million cable or something like that. It's cable. That's the pet name given for sterling pound. What's the name for the US dollars? There's another name. That's called greenback. Canadian dollar. They call it Luna. Likewise, there are some pet names. If I remember, yuan is such a name. Sometimes some people call Chinese yen, but still renminbi is the official word, official currency. Okay, when we talk about releasing of economic indicators, that this is again important. So the economic or the GDP is going to release on this date at this time. Then the market will have an view on that. Okay, GDP would be 3%. This quarter GDP would be 3%. Then that's the market's view. Market will adjust for that, for 3% GDP. But what would happen if it comes as 3.1 or 3.2? It is a shock to the market. It is not what the market expect. Then the market will start to react. Okay, GDP is much better than what we expect. Currency should appreciate. If it comes like 2.5 or something like that, then market will react. So it's not the number that you get. That's against expectation. That's we call the shock. The shock given by that economic release, indicator release, that drives the market. So you expect GDP. So say last quarter GDP is 2.5. Now it's fine. We know that the market expect GDP to be 3% this quarter. It comes as 3%. What would be the market reaction? It's good because last quarter 2.5, this quarter 3% increase in GDP. But market won't move any direction. Just purely based on that number because it was expected and market has adjusted already for that. If there was any deviation from that expectation, only the market moves. So when you look at economic numbers or indicators, that's what you should expect. And how do you interpret the numbers and the market, expect the forecast the market movements? It's not the number, it's what is it, the number comes against the market expectation. So other events like unexpected political events maybe so even 2019 we had such event, unexpected political events in October. So the government toppled. That's a unexpected political event of a country. So that may considered as bad or good, or that may create uncertainty whether this government is legal government or not, something like that. If a president of a country is assassinated, what would happen? So that would add to the uncertainty. Then that will drive the market. All those events that can happen. Okay, I mentioned, so I'll take you through a few examples on these events. So this is a news article on September 11th. Can you see the date here? 9/11/2001. 22/19/22. So on that date, what was a news article on Bloomberg? Dollar tumbles after terrorist attack on New York, Washington. In US currency plunged 2.9% against the Swiss franc. See, this is the other safe haven currency that I mentioned. Its biggest drop since May 1970. That's what happened. Immediate reaction is this is negative. This will happen. But if you go through this, there were some other currencies, those were depreciated against US dollar, because even US dollar is considered as appreciation. Even after this event, if you check the history, you won't see a big decline in US dollar. But immediately on that day, as you mentioned, the dollar fell 1.9% against euro, biggest decline since April 3rd to 91.5 US cents per euro, and 1.5% against the yen, 219.09 yen. So against most of the currencies, dollar depreciated initially. Okay, then 2011 there was a earthquake in New Zealand. So this is the date where the event occurred. I think it's lost about 50 billion New Zealand dollars. That was the final assessment of the impact to the economy. What would happen? What happened? Not would. What happened? The currency, New Zealand dollar, depreciated. Remember, this is New Zealand dollar. New Zealand dollar is the exchange rate. So New Zealand dollar is the base currency. Exchange rate going down means New Zealand dollar depreciated. So it started to depreciate, though there may be small hiccups, ups and downs, but generally trend is to depreciate. It depreciated up to this point. What is this point? That's another thing. It depreciated continuously for 22 days. Then March 11, a tsunami was hit in Japan. Earthquake and tsunami. So that's the point. What has happened? What has happened here? What has happened to the dollar yen exchange rate? This is dollar yen exchange rate. Can someone interpret this?
So it has gone down and then began to recover.
Yes, it has gone down. That means, what does it mean by gone down? The exchange rate gone down. The yen,
So
yen has appreciated.
has appreciated, yeah.
Yen has appreciated. Say the tsunami was hit in Japan, but the currency appreciated. Why? Immediately. Then, how many days? It's only 7 days. Why? Then what had happened? It started to depreciate. So the thing, what happens here, Japan, the situation is most of the Japanese investors, including in insurance companies, since they have very low interest rate, they invest overseas to earn the interest income. And the currency is at a depreciated level. So when they convert foreign investments back into Japanese yen, they get the advantage of that as well. So the situation or the status at this point is there are a lot of foreign investments. The moment the earthquake strike, what happens? They know that they want to build this economy. They need their money back. They'll start to bring their money back from overseas. So the currency appreciated. Then what happens? G7 countries with the support of Bank of Japan, even Bank of Japan or the Japan does not want to appreciated currency. So they intervene. G7 central banks, they intervene. All 7 countries intervene in the market to stop yen appreciation. This is a very rare event. So that's what happened. That's the date in this New Zealand dollar started to appreciate again. Until such time, New Zealand dollar depreciated. Only with the intervention by G7 countries, New Zealand dollars started to appreciate. See, the same thing, but in 2 different countries, 2 different impacts. Here, New Zealand dollar depreciated, but here, yen appreciated. So almost same sort of natural disaster. But then policy intervention that drives the market other way around. So
these taking back investments must be excluding the invested in bonds, right? Bonds, then sudden withdrawal, it will be a premature, right? So
yes,
except bonds.
no, it's not. Maybe the bonds. That's the easiest thing to take it back, not the long-term investment in companies. So, maybe shares, maybe bonds. Those are the most liquid form that they can sell and take it back. If they have invested in a plant, they cannot sell the plant and take their money. Hot money always flow into bond market and the share market. The other things they will sell it and take it back. That's what happens. Even Sri Lanka, what happens just after this COVID? Those foreigners who have invested in rupee bonds, what did they do? They sell their stake and take their money back. Even in the stock market, just monitor Sri Lankan stock market daily. whenever the market is up, stock market is up, see who is selling, who is buying. Monitor that. You can realize the real picture. So Japanese investors, the easiest thing for them to take it back is the bond investments and the share investment. They can sell it and sell it in the secondary market and take it back. They don't mind whether it's premature or not. Okay. Anything else? Any other question? Shall we take a break here?
So small question is there. Hello.
Yes, go ahead.
Sir, why central bank give two rates for the yuan? One is offshore and normal rate.
Yes, it's not the central bank is giving, I think. Central bank, there's a
What
market.
I'm asking is why they indicate that two
No, there are two exchange rates. In the offshore, they have established a separate currency. We don't call it CNH, it's CNY. Sorry, CNY is the official currency code. Offshore one is the CNH, Hong Kong. That's why. So they have allowed some portion to trade freely in the offshore market, not in the within China. So that's why there are two different exchange rates. So anybody can trade in CNH, but not in CNY. So all those CNH are settled outside China, not within China. It may be a bank in Hong Kong, most probably. Bank in Hong Kong. So there's a small risk.
That
means it's not the currency same as in or issued by PBOC, People's Bank of China.
So that means it's a different center you are talking about?
Yes, two different center, and it's not exactly Chinese currency, but with less restriction you can trade in offshore currency. That's having sort of having two different currencies. It's somewhat backed by Chinese government. The another step that they have taken to popular their currency and ask others to get more exposure. If something goes wrong, this is my view, I'm not sure. If something goes wrong, they will say we don't have anything to do with CNH. It's your loss, you will take it. But in investments in CNY and in within or the onshore investments will be okay. But everything goes smooth, one day they will merge it and allow them to trade it, bring that money into China mainland and consider it as Chinese yuan, allowing everybody to trade it freely. Since the reason for two different rates is CNH, the offshore one, there's no restriction, so anybody can trade. So there will be a lot of demand for that. So due to that demand, it's at a slightly appreciated level than CNY. And CNY, you cannot trade freely. There's a small band that's given by or decided by PBOC. So even for there's something bad news, nobody can sell it and let it depreciate beyond that band. So it will be within that band, but it won't applicable for the CNH. It's freely convertible. Anybody can sell or buy. So even in a bad news, people will or investors will start to sell and currency may depreciate. So then the rate may not be same as the official currency CNY, Chinese renminbi. That's why we have two different rates. The CNY rate is decided by the central bank, but not the CNH offshore one.
Thank you, sir.
Okay, shall we take a break? 10 minutes.
Yes, sir.
Now it's 11:15.
Okay, sure.
We'll come back 11:25. Is it too slow, or what is your comment on that? Initially, it's okay. I was thinking to finish it before 10:30 and start the fixed income part, but the way that we are moving, I don't think we will be able to do that. Okay, it's okay, fine. If you have any comments, please let me know. Okay, we'll take a break. About 10 minutes. These, I think that's enough from the foreign exchange side. Other than that, how do we use or how do you hedge? How do we hedge foreign exchange risk? We'll discuss that in the risk management side once we discuss about derivative transactions as well. Then we can discuss how to hedge foreign exchange exposures. So under financial markets, we discuss about different market segments. Then we discuss about money markets, then foreign exchange market. The third one is the bond market, or we call it fixed income securities market. So that's the one we are going to start now. Probably not today, but next week we may have to move into some calculations, like calculating present value. So again, if you cannot remember how to calculate present value, please revise before you come to the class next week. So these are the things that mostly we are going to discuss. What are fixed income securities? So what is a bond? What is a bond? Again, it's a financial obligation of a firm or an entity, and that entity or the borrower, we call that entity as the borrower, promises to pay a specified amount on a future date. So remember that here it doesn't say obligation to pay back the amount borrowed. You can say, but it's not the exact way. The borrower or the entity, which is issuing a fixed income security or bond, is agreed to pay a specific amount on a future date. That's the basic structure of a fixed income security. And that one, the other thing is, it is simply a traded IOU. That means it's a what do you call IOU? It's sort of memorandum of understanding. So it's an agreement between two parties, but only thing is that agreement can be traded. The buyer of that instrument can sell it to someone else, not back to the issuer. That's the key feature. The ownership can be transferred. That's why there's a secondary market exists. So bonds, we simply call bonds, but technically we can say fixed income securities are obligation of a one party. That party is we call borrower, to pay back some money on a future date. There may be interim interest payments which is agreed upon at the beginning of the transaction. And the other thing is the ownership of this security can be transferred to a third party. and whoever who holds that has the claim against the borrower. So to understand what is a fixed income security or a bond, the government bonds that we know, that's the most common thing. But not only that, even corporates, they can issue bonds like that. In Sri Lanka, we call them corporate debentures, but it's a bond. So what are the key features? Oh, we have to identify few parties. The first party is issuer. Issuer means the borrower who is borrowing money. That party promises to make the payment on a future date. That party is called the issuer or the borrower. The issuer agrees to make payments, maybe one payment or more than one payment, but the dates are specified, whether it's interest only or interest and principal or principal only. Those are specified in the agreements. So the issuer is issuer, in other words, the borrower. That's the party who borrows money. So in the case government bonds, who is the issuer? Government bonds, treasury bonds in Sri Lanka, who is the issuer?
Central Bank.
What's, sorry, come again?
Central Bank.
Who is the issuer of government bonds?
Government.
Yes, government. Go back to the definition. The entity that promises to make the payment, or obligation of an entity that promises to pay a specified sum of money. Who is the specific entity that gives the promise that we will pay that? It's not the central bank. It's the government. That's why we call it government bonds. Otherwise, we call it central bank securities. There's instrument called that central bank securities. If central bank wants to borrow money, central bank can issue a security. Basically, that can be done, or it was used to open market operations. When your central bank does not have enough government bonds or bills to conduct open market operations, central bank was used to issue its own securities, central bank securities. But government bonds, our topic is fixed income security market. Government bonds are issued by the government. So that means indeed it's an obligation of the government, not the central bank. What the central bank does is do the operation on behalf of the government, conduct auctions and borrow money and give that money to central bank, to the government. Central bank does the agency activity or facilitating the transaction. Everything will be settled through central bank accounts that banks and primary dealers maintain with. But ultimately, the obligation is with the government of Sri Lanka, that social republic, whatever, government of Sri Lanka. Any country, it's the same. Government is the obligor, not the central bank. Then the other party is investor. When there's a borrowing, there should be a lender. We call that party who purchased that fixed income security, we call it purchase. When you lend money to buy a bond, we call it buying a bond or purchase a bond or fixed income security. That party is the investor. That can be an individual or a corporate or a bank, whatever, any institution. Then the other word is maturity. What is maturity? Even in a loan that you grant, there's a maturity date where the agreement comes to an end. That's the maturity. Even in a bond, fixed income security, there's a maturity date, on which date the borrower would pay the promise amount. After that date, the security is no longer exist. There's no relationship between investor and the borrower, or there's nothing to pay by the borrower to the investors unless it is default. If the borrower does not pay on that date all the cash flows, it is considered as a default. So the maturity is has the same meaning as you mean it in a loan. So the maturity period can be few months in a treasury bill, like it can be few months or can be many years, 10, 20 years or 30, 40 years. There are some bonds, perpetual bonds as well. There's no maturity. It remains there forever. That is also very rarely there are some bonds like that. Then the par value. This is again very important. Remember this. The par value is the amount that the borrower agrees to pay at the end. So remember, I didn't refer anything to the amount that the borrower borrows. I always talk about the amount the borrower is going to pay or agrees to pay at the end. That amount we call the par value, or sometimes we call it face value, redemption value, or the principal or value, or the maturity value. So all those words, principal value, face value, redemption value, maturity value, par value, all those are referred to the amount the borrower or the issuer promises to pay by the maturity date, the principal amount, without interest. Remember that the par value, it does not include any interest, but the principal amount that the issuer promises to pay by the maturity date. That's the par value. Then there are different redemptions. That means how do you pay that par value? The first one is, the most common one is bullet maturity. That means the issuer agrees to pay the entire amount, the full par value or the full principal amount in one go on that maturity date. That is we call a bullet maturity. So there's only one principal payment from the borrower to the investor on the maturity date of the fixed income security or the bond. That is we call bullet maturity. No principal payments during its lifetime, only at the end. That means on the maturity date. We call those bonds are having a bullet maturity. There are two other kinds of bonds very commonly used: callable bonds and puttable bonds. So in a bullet maturity, before the maturity date, investor cannot ask funds from the borrower. Neither borrower can repay investor before the maturity. None of the parties is allowed to do that. That means either to ask money or repay early. But in callable bonds and puttable bonds, that flexibility is there. In a callable bonds, that is an option available for the borrower. Callable bonds, that's an option available for the issuer to repay the bond early. That's the basic concept. Borrower can repay without waiting for the original maturity date that he agrees, but he cannot do it, or the borrower or the issuer cannot do it at his or her own discretion. At the time of issuing the bond, in the contract, it should specify on which date that they can do that. Or there may be a time frame. Within that time frame, the issuer cannot hold the bonds or cannot repay the investors, but on a specific date or after that, they can do it, repay it, but again only on specified date, not any date, only on specified date. Even in that, even the price might have what is the amount that they are going to repay might have explained in the agreement or agreed in it. However, so the terms may differ. However, the basic concept is, in a callable bond, the investor, sorry, not the investor, the borrower or the issuer can repay fully or part of the principal that agrees to pay back before the stated final maturity, but based on an pre-agreed schedule. The puttable bonds, that gives the option to the buyer or the investor. Investor can ask money back from the issuer before the maturity date. Again, there are specific, or there should be a specific schedule on which date that the investor can do this, not any time. So in the puttable bonds, that's an option available for the investor to ask their money early before the maturity. In the callable bonds, that's an option available for the issuer to repay the principal amount before the maturity date. Any question? Is it clear?
Excuse me. Is the par value and face value always the same? Is it both are same?
Yes.
Concept is same.
Same. Yes. That's the amount that in fixed income securities, that's the amount the borrower agrees to pay. What's the principal amount that agrees to pay?
Okay. Also, the callable and puttable bonds, they are presently, is it traded in such way? I mean, compared to T-bills, T-bonds, and debentures,
not in Sri Lanka. I don't know. Not in Sri Lanka. Then the other form is serial redemption. That means without having a bullet maturity on the maturity date, at the maturity date, the last date, there can be series of repayment of principal amount over a period of time. So the issuer pays part of principal amount, and over a period of time, then by the maturity date, the whole principal is paid out. Then, as I mentioned, perpetual redemption, there's no fixed maturity. It gives a steady stream of just interest income indefinitely. Whoever who issued agrees to pay that interest income forever for the holder.
Then who decide the maturity date, sir?
There's no maturity. In which one? In the perpetual redemption?
Yes.
No, there's no maturity date. That's why.
But any time investor can redeem the deposit. Investment.
No. There's no redemption. Practically, there's no redemption. Only the interest income.
Right. Then whatever agreed at the initial date.
Yes. At the beginning, you agree whether to receive a floating interest rate or the fixed interest rate, and they agree on an amount. On this amount, that I pay, that notional amount is there. What is the amount? On that, they will calculate interest and pay it. But no principal
Then what is
value.
the rationale for, yes, what is the rationale for having such a scheme?
That depends from maybe issuer's point of view. They may think it's cheap to do in that way. Say if you borrow money, say okay, even 20 years back, if you borrow money 20%, okay, now you are paying it at that rate. With the time, maybe that interest amount is negligible now when you compare with the inflation and purchasing power. It's not a big amount. So when you say it's for infinite, you just get that money and you keep it by paying say 100 rupees or whatever every month. When it comes to 100 years, the amount is nothing. Even the borrowed amount, maybe it's not that big. That may be the reason from the issuer's point of view. From the other side, from investor's point of view, they might think you have a fixed cash flow, and you don't.
Both parties highly
Yes
engage with interest rate risk, no?
Interest rate risk, yes. But very rarely these sort of bonds are issuing now. Then the other one is convertible bonds. That is, it is issued as a bond. So issuer promises to pay a certain amount of money by the maturity date, but there's an option again to the buyer or the investor to convert that bond into shares of that entity. So the number of shares, so for one bond, how many shares that you can buy, all those things are specified in the agreement. We call it covenant. On a specific date, if the investor thinks without holding this bonds, it would be better to hold shares of that firm, the investor can convert the bond into shares. That's a convertible bonds. Okay. Now we talk about shares, and it's a good time. Even I remind it. What's the difference between having a investment in share and a bond?
The less priority for shares when any bankruptcy or any liquidation.
Yes. So bond is a obligation for the borrower or the firm. Oh yes, issuer. Say we use the word issuer. For the issuer, bond is an obligation. That means issuer has to pay that amount. But what is a share? When you buy a share, you get the ownership of that entity. So you are the owner. So you run the business. You take the decisions. But in a bond, it's not. You just lend money. As the investor, you just lend money to another entity. That entity has to pay back as per the agreement. So bondholder has a claim against that firm, but shareholder, there's no such claim. Others have claim against you because you are the shareholder. So you run the business. So that's That's the difference. And as he mentioned, when it comes to a bankruptcy proceedings, bonds, you have to pay it because it's an obligation. Once you pay all the obligations, and if there's anything remaining, only that will get by the shareholders. Shareholders will receive that if there's anything left after giving or paying back all the obligations and meet all other requirements. That's the difference between shares and bonds and the risk of shares and bonds up to some extent. Is it clear? You should know that difference. Holding shares and holding bonds as an investor's point of view as well as from the issuer's point of view. Then the coupon rate. Again, this is a very specific word used here. Coupon rate is the interest rate that the borrower agrees to pay. Clear? That is the interest rate the issuer agrees to pay. Say for a government bond, if they say 9%, that means every year the government agrees to pay 9% interest on the amount, on the face value. We call it as a coupon rate because there's a historical thing. Before these IT systems and things come into play, earlier the fixed income security is issued as a security or paper-based certificate, as a certificate. There's a certificate saying that face value is this much, the interest rate is this much, the name of the holder saying that, like you get a fixed deposit certificate when if you go to a bank now again, even we don't receive that one as well through online banking. Yes, but we got a certificate. But attached to that certificate, there was small coupons because, say, the bond is issued for 10 years. Every year, the issuer has to pay the interest amount for the bondholder. So for each interest, there's a coupon. There are coupons attached to the certificate, small coupons. When the investor wants to get that claim to collect the interest amount, he has to take that certificate and present it to the issuer or the book runner or whoever who facilitates that payment. Then only the investor gets the interest payment. The issuer will detach that coupon, relevant coupon from the certificate and keep it and give the interest amount to the bondholder. So that's why the name coupon comes in, and that interest rate we call it as the coupon rate. Then that's the coupon rate. The coupon is the interest amount. So based on the face value, based on the coupon rate, what is the periodic interest amount that the bondholder has to pay to the, bond issuer has to pay to the bond holder. So this is basically coupon is the interest amount, coupon rate is the interest rate, and the interest rate is specified annualized interest rate. Is it clear? Coupon rate and the coupon, the difference? Coupon rate is the interest rate as a percentage, and the coupon is the amount in absolute terms, in terms of rupees or dollars or whatever currency. But the coupon rate is maybe 8%, 9%, 5%, 20% or as a percentage. Then the fixed rate bonds and the floating or variable rate notes. In a fixed rate bonds, the coupon rate is fixed for the lifetime of the bond. If it is a 10-year bond, coupon rate is 5%. For the whole 5-year, the rate is fixed. Interest rate is fixed at 5%. It won't change. But opposed to that, there's another one called floating or the variable rate notes. Depending on the agreement, that coupon rate is changed periodically, maybe every 6 months or every year or every quarter, depending on the agreement, it will change. But how do you change? There's a rule in the agreement, there's a rule, and basically there's a benchmark interest rate, say like LIBOR rate. Depending on that, you may add a fixed margin to that, but when that benchmark interest rate changes, the floating variable or the floating rate coupon rate changes. Then the next coupon will be paid on the newly set coupon rate. Say bond is issued for a 5-year period, and assume it's a floating rate and linked to the, say, specifically LIBOR 6 month. It's the benchmark rate. So if it is issued today, what is today LIBOR 6 month rate? It is the applicable coupon rate for the next 6 months. So based on the face value, the coupon will be paid after 6 months, calculated at the coupon rate fixed today. Then after 6 months, again, check what is the prevailing LIBOR rate. That will be fixed as the coupon rate for the next 6 months. Likewise, every 6 months, this coupon rate is changed or reset. So if the interest rate goes up, coupon rate goes up. If the interest rate goes down, coupon rate goes down. So that is how floating rate notes are issued, and that's the mechanism. But there are some other bonds, they don't have specific benchmark, but there's an pre-agreement. For the first 5 years, say for the first 5 years, this is the interest rate or the coupon rate. After that, for the next 3 years, another interest rate. Likewise, for different tenors, different interest rates. We call it step-up notes. That means for the first period, low interest rate, the second period, slightly higher interest rate, for the third period, slightly or more higher interest rate, or step up or step down. That can be other way around. For the first period, high interest rate, second period, low interest rate, and third period, much lower interest rate likewise. So for different periods, different interest rates are fixed, but at the beginning. But that is step up or variable notes. But in the floating rate, the benchmark is there, benchmark rate is there, and periodically, depending on the period agree, the coupon rate is changed. If time permits, we'll try to do an example of this, how to fix it. So this is an example of a bond issue in Sri Lanka, very recent bond issue, 12th May 2021. I just wanted to highlight here the few concepts that we discussed. So here you can't see who is the issuer, but Treasury board, the issuer is government. There are two series. That means two different bonds. What is this 9%?
There is coupon rate, no, sir?
That's the coupon rate. What is this 2025?
It is maturity year.
It's the maturity year, but you can see in the next row, date of maturity exactly given is what is the maturity. 1st May of 2025. Even here you can see coupon rate 9%. Both, even the 2025 maturity and 2028 maturity, coupon rate is 9%. No difference. Can someone explain what is A and B? This is something unique in Sri Lanka. So if you have the have two bonds with the same maturity, they put like A and B, something like that. So, but what you have to worry about the coupon rate and the maturity date. This ISIN, International Securities Identification Number, it's a unique number assigned to a particular series to identify that security. It doesn't follow or go by with the coupon and the maturity, but this number, it's very specific. It's only for assigned for a very specific bond.
Sir, why does the coupon rate is similar in both occasions? Because maturities are different, right? Shouldn't it have a different coupon rate?
Not necessarily, as this says. That can be same, but if investors thinks 9% is not enough for 2028, it will be adjusted through the yield. So we'll come to yield. This yield is the real rate or the actual return that the investor gets.
That's for the remaining maturity, no, sir?
Remaining maturity, yes.
Okay.
So here you can see for this bond, the investors get only 7.04. For this bond, you get 7.97 return. So we will discuss this. How do we decide price and what is yield? Then you will realize this.
Also, the ISIN code basically it's derived from the bond details, no?
Yes.
The
yes.
year of maturity,
Year of maturity,
date.
month, and yes. There's a way how to get it.
Yeah. Also, the weighted average yield rate is where the present value calculation comes into play for us in future, no?
For this time, at the time of issuance, yes. You use this.
No, even for fixed income, you were talking about present value should be important. So we'll be using that present value calculation at this calculation points, no?
Yes.
To derive that.
Sorry?
We might need the present value calculation that we studied some time back, is it?
Yes.
So that is
yes.
basically for this yield calculation, is that so?
Either way, either we can use yield to calculate the present value, or we can use present value to calculate the yield.
Both ways.
Both ways, yes.
So that then when we compare the coupon rate, that your coupon payment will be paid at the rate of 9%, no?
Yes.
So what is this date of settlement? Is the trading date?
No, again, so whatever the transactions that we discuss in this course, there will be a trade date and a settlement date, two things. But in this case, this is a primary auction. It was held on 12th. I think there was a holiday. So, however, the settlement is taken place on 17th May. I cannot find the holidays here.
That is 2 days after the bid, no, sir?
Yeah, yes. So, say 12th is Wednesday. That's the normal practice.
Yes, 13th and 14th is holidays.
13 and 14 are holidays. So, therefore, the settlement day has put on to 17th. Otherwise, general practice is we conduct auctions on Wednesdays and settle it on Friday. But due to these, was it only 14 holiday? 13 and 14 both? I think only 14.
Only 14th was already.
Only
14.
14.
Only 14, sir.
So T plus 2 goes to 17. That's why the settlement date is on 17.
Also, the weighted average yield rate that is mentioned here, this is for the primary dealers rate or what, Chanda?
This is, yes, so the whole issue, they have accepted only 10 billion, no?
Yeah.
For the 10 billion, this is the weighted average yield.
Okay, weighted average yield. So for each primary dealer, there could have been a different rate, no?
Different rates, yes. We'll discuss that when we discuss about primary auctions, how to, we didn't discuss that, no? No, we didn't discuss how to conduct primary auction and draw the lines.
If I'm not mistaken, no.
No, yes. We'll discuss that. How do we decide these prices and weighted average later? Shall we move on?
Then that coming to number one, ISIN number, there could be further bids in future, though there is a offered amount is fully subscribed.
No, unless public debt department announces it again and asks to bid it, there can't be. Once the auction is over, it's over.
Yes, but in number two, there would be, no, that it has not been fully subscribed, no?
Even in the second one, no. Whether it's fully subscribed or not, once the auction is over, it's over. But the public debt can do a reissue.
Reissue under same ISIN
Under
and same
ISIN, yes.
Same maturity date, no?
Yes. When it say same ISIN,
you can't change. No? Yes.
You can't change anything. Maturity rate, coupon rate, everything is, all those things are there. Only thing is the amount offered
and weighted average might be changed.
Whatever amount that government wants to borrow, they can increase it. And the accepted amounts and the weighted average, that depends on the market conditions.
Right.
We will at the time of the auction.
And
but
that means that
coupon and the features of the bond won't change. That means the coupon, maturity date, it won't change.
The remaining maturities will be time to time shorter, no?
Shorter, yes. Shall we move on?
Yes.
And another difference is zero coupon bonds. The bonds that we discuss here, there's a coupon rate, 9%. But the next one, this one, zero coupon bonds, like treasury bills. Treasury bills, there's no interest payment per se. You buy it at a particular price, and on the maturity date, government will pay you the face value. The difference is your interest income. But in a bond, it's not like that. So if you go back, does it say coupon rate per annum? That's it. But in Sri Lankan government bonds, every 6 months, government pays interest. But in a zero coupon bond, the maturity may be long term. That's why it says bond. It's not a bill. Maybe 5 years. No interest payment during that 5-year period. On the maturity date, like in a case of a treasury bill, the borrower will pay back the face value. No interim cash flows, nothing. On the maturity date, only the face value. That is we called a zero coupon bond. So like in a treasury bill, when you buy such instrument, you buy it at a discount lower than the face value. The same thing applies here. Zero coupon bonds, investors buy it at a deep discounted prices, and on the maturity date, investors receive the principal or the face value.
It's similar to treasury bill, no, sir?
It's similar to treasury bill, but the maturity period is more than 1 year.
That, yes, yes.
Yeah, that's it. Yes. Then the coupon frequency. So I just mentioned that government of Sri Lanka pay every 6 month interest. Every 6 months pays interest. That is the coupon frequency. That means per year 2 interest payments. So that is what we call coupon frequency. There can be some bonds. The interest is paid only once per year. At the end of the 1 year period, there will be a coupon payment. The next coupon payment will be at the end of the 2nd year. So the coupon frequency is 1. We call it annual coupon. But there can be issues. Coupons are paid 2 times per year. That means every 6 months. We call them semi-annual coupon. Then the coupon frequency is 2. There's only 2 semi-annual periods in a year. So the coupon frequency is 2. There can be some bonds, coupon frequency is 4. That means every quarter they are paying interest. Or it can be 12. Every month coupon is paid. Or maybe every week. So that has to be decided at the time of issuance and announced to the market. Okay, this is the coupon rate and this is the coupon frequency. Clear? What is coupon frequency? So then we'll move into some calculation. The coupon amount, the coupon that I mentioned at the beginning, even in the topic it says still coupon. How do we calculate the coupon amount? This is the equation. So coupon amount is derived using face value. That means what is the amount to be paid on the maturity, what is the stated coupon rate, and divide by the coupon frequency. So put it into an example. Assume face value is 1 billion, though in this amount of offered is 10 billion and accepted amount also 10 billion. We can say the face value is 10 billion then. But to make it a little bit simple, I use face value is rupees 1 billion. That means, what does it mean? Face value rupees 1 billion. On the maturity date, the issuer has to pay back 1 billion rupees in aggregate for all investors. This 1 billion may be distributed among different investors, number of investors. Depending on the amount that they bought, they will get their quantum. But this is the total amount. The issuer agreed to pay 1 billion rupees. That's the face value. Then the coupon rate is 9%. This is per annum. And the coupon frequency is 2. That is, every 6 months, there will be a coupon payment. That's why it says semi-annual coupon payments. Then this is the equation. Then how do we calculate the coupon amount? That means, what is the interest amount the issuer paid at the end of 6 month period? Face value is 1 billion, then 1 billion into coupon rate 9%. Remember, this is a percentage, so don't write 9. But you have to put here, substitute at the coupon rate. This one 1 billion, that's fine, into what's the figure that you are going to substitute?
9 divided by 100.
Either 9 divided by 100 or 0.09. Remember that. That's a very common mistake that you do. And coupon frequency. What's the answer?
45 million.
$45
Million.
million. So the answer is there. So every 6 months, government has to pay 45 million as the interest on this borrowing. Okay, what is that 6 months? If we go back to this, assume 17th May is the settlement date. What would be the next coupon date? That means when would be the first coupon is paid?
November 17th.
November 17th.
November 17th. Settlement date is 17th May. 6 months from this is 17th November. Sorry, 16th November. Remember, it's not from the, you are not counting from the trade date or the issued auction date. It's from the settlement date. Sorry, I did a mistake. Indeed, this is wrong. Why? There was a maturity date. Maturity date is somewhat different. No? We have to start from maturity date. Indeed, maturity is 1st of May, not 17th May. So we have to come back from this maturity date. Then what would be the next coupon date?
1st of November.
Yes, it should be 1st of November. Because we start from the maturity, it's 1st of May, then 6 months prior to this 1st of May, this is 20, 25 or whatever. Then come back 6 months, it would be 1st of November 2024. This is the cycle, coupon cycle. So therefore, for this bond, the next coupon will be paid on 1st of November 2021. What is the amount? 45 million, what we calculate here. Is it clear? If the settlement date falls in line with the maturity date, then we can work from the settlement date into the future to find out what are the coupon dates. But otherwise, we have to start from the maturity date and come back every 6 months, because last coupon and the face value will be paid on 1st of November, sorry, 1st of May 2025. what is 6 months prior to that? That is 1st November 2024. Likewise. Any questions? Any questions?
Sir, why that happens like that?
Sorry?
I didn't understand why that happened like that. The maturity date first of May.
Because that's the norm. We pay the last coupon and the interest amount on the maturity date. So then, and there will be coupon every 6 months. So therefore, it should follow that cycle from the last or the maturity date. We come back 6 months. Then what is the date? That's May 1st and November 1st. Those are the dates.
So no change in the amount, right?
Sorry?
No change in the amount. Coupon.
No change in the amount. So every 1st of November and every 1st of May until 1st of May 2025, bondholders will get 45 million as interest.
This happened because the 36-4 they restructured it.
Okay, yes. Here. No, for the coupon it won't matter. For the coupon, this is 45 million. There won't be any change.
No,
Whether you calculate actual 365 or actual, it won't change. Coupon would be this 45.
No, sir, I asked that maturity days change because of that 364.
Sorry, maturity?
Dates change that does not come as date of this.
No, yes. Say what we are referring in treasury bills. We discuss for a year there's only 364 days, and for bonds we consider 365 days. That's the concern you have. Yes, but irrespective of that, the coupon would be this. Whether we use there are few different day count conventions used in bond market. I think I discussed it. One is actual 365. This is the one we use in Sri Lanka, no? Then the other one is actual. The other one is 360. Depending on these, some of the calculations may change, but remember, for the coupon payment, none of this matters. Only these: face value, coupon rate, and the coupon frequency.
Yeah, the maturity days they change because of that, no? Basis because of
No. Maturity date is decided by the issuer. That's his discretion.
Okay.
Nothing.
Here, sir, that yes. Here, sir, in this example, that in this bond auction example, then you will get the first coupon rate prior to 6 months. That means that
Yes.
rate will be adjusted to the weighted average rate. No, sir?
No. You will get first coupon on 1st of November 2021, 45 million. For the time being, just remember that. Though you buy this bond on 17th May, because it's the settlement date, This is the settlement date. You buy this on 17th May.
Yes.
You will get next coupon on 1st of November 2021, full amount.
Yes, that means prior to completion of 6 months, no, sir?
Yes, prior to completion of 6 months from this date.
Yes. Thereafter, in every 6 months.
Every 6 months, you will get the same coupon, still the same coupon.
Yes, because of that, you are getting advantage in first coupon payment because you are getting it lesser than 6 months. That is that might be reason to have a much yield.
No.
No.
I'll explain it. Remind me to explain that once we discuss this.
Right. Okay.
I'll explain at that point. Remind me. I will forget about it. So we'll stop here because we are going to start about pricing and these calculations. Now it's not. We don't have time to go through all those things. We'll stop here. Remember this equation, how to calculate the coupon. That depends on the face value, coupon rate, and the coupon frequency. Nothing to do with the day count convention. Nothing. Just all these things. All these day count conventions and things will be matters when we are going to discuss that accrued interest and things like that.
Sir, one more question. Now, when we calculate coupon rate based on the face value,
wait. We are not going to calculate coupon rate. Coupon rate is given.
Yeah, coupon based on the face value. Aren't we take into account the future interest?
No. It's
now,
like
the face value contains the future interest as well, no?
No. It's like if you grant a loan today for a customer, 10-year loan, 10% interest, the 10% is means there every day you calculate the interest on 10%. Same thing. Only thing is in your most of your loans there will be reducing balance method. That's the only difference. But still you charge 10%. You don't consider future interest or nothing. Isn't it? Hello.
So now we invest. If we do the settlement today, this 1 billion is the amount that we are paying today.
No.
That is my question. Is if we pay 900 million, if we calculate the coupon amount, that 10 million will be the future interest. We are calculate this.
No,
including the 10 million interest that we are going to pay.
No, nothing like that. So whatever the face value, that the interest amount is calculated based on the principal amount, that is face value that the borrower agrees to pay on the maturity. What to buy that? What is the amount that you pay today? It's irrelevant.
That means two different yields for the same this instrument. Right?
No. There's no two different yields. Whatever the price that you pay, depending on that, your yield will be decided. Basically, indeed, what you do, you decide what is the required rate of return on this investment. Based on that, you calculate what is the amount that you are going to pay. You pay that amount. That's it.
So the price should reflect whatever the future interest impacts, right? Is that?
Yes. When you decide the required rate of return, you have to consider that. Whether interest rate will increase in the future or decrease in the future. And the maturity period, whether you buy this for a 5-year period or say this is a 4-year bond. But so you can see here, This one is a 4-year bond. Yield is 7.04. This one is a 8-year bond. Sorry, 7-year bond. Yield is 7.97. The yield is high for the longer duration. That because you factor that. The market has factored that 3-year extension compared to this one. If it was a 2-year bond, this may be something 6.5 or something like that. So the yield is decided considering all those factors.
Apart from the coupon rate, even the yield is dependent on the market conditions also, no? Present prevailing rates and everything.
Yes.
So that is the yield is not a fixed amount for everyone. It could differ on the way that we negotiate also. Is that so?
There's no negotiation in a primary auction. In this, depending on what you bid. When you bid, you have to consider all those market factors. At what rate you are going to buy this?
Yeah, so company A might consider certain factors and bid at 8%. Company B might consider all those factors and bid at 7%.
Yes, that can happen.
Sir?
Yes.
That 1 billion is amount that the investor has to pay, no?
No. Investor will not, or may not pay that 1 billion. It may be more than or less than that, or maybe exactly 1 billion, the face value. It is that's why from very beginning, I highlight that I didn't talk about what is the amount that investor pay. I always talk about what is the amount that the borrower is going to pay on the by the maturity. What is the principal value that the borrower is going to pay? Not the amount that investor is going to pay to buy this. It's completely different. Two different things. It can be the same face value or it may not be.
The amount that the investor has to pay, how it decided?
We will discuss when we discuss about how to calculate the price. That depends on all these factors: coupon rate, maturity date, and whether coupons are paid semi-annual or whatever the coupon frequency, and the yield.
Okay, thank you.
So you can see the next we are going to discuss what is the price. That's the price that you are going to pay. So based on that, whether it's discount, par or premium, and there's a concept called accrued interest. Then later we are going to discuss, once we finish accrued interest, how are we going to calculate the price that you are going to pay to buy this bond. So these are yet to discuss.
Do we discuss how to calculate the yield also?
Sorry?
Do we discuss how to calculate the yield?
Not really. That means that's right. So this is the equation that we use to calculate the price. So this R is the yield. So what we generally use, we decide the yield and the coupons are known and the face value is known, time period is known, then we can calculate the price. But if you know the price and the other factors, we can calculate yield, but it's not a straightforward method. You have to do follow a iterative process and come up with the yield, but it won't help you practically. How do you decide the yield? That means if you want to, it's like, say, if it's like if you want to buy a car today, how do you decide what is the pay? Since you have only 1 million, you cannot say I pay only 1 million to this car. You can't do that. You have to consider several other factors. What is the module? What is the manufacturing date? What's the condition of the car? Ownership? All those things. Then you decide a fair price. Likewise, in deciding the yield, you have to consider all those things. Say, what is the maturity? What is the coupon rate that it's going to give you? And who is the issuer? Whether you can trust on that issuer. What is the credibility? Whether that party will pay it back. And what would be the interest rate environment in the future? Whether you have any other opportunity to invest in somewhere else. If it is the case, what is the return that you can expect? But then related to the risk, there may be opportunity that you can invest it at or giving a return of 15%, but at a higher risk. Whether you take that one or you take the government risk, low risk, and invest it in 7% or 8%. Those are the things that you have to consider. What would be the interest movement in the future? What would be the liquidity premium? Can you remember we discussed about interest rate? There are different components. Inflation or can you remember? We discussed about nominal interest rate. That's the thing that you have to do. You have to think about all those factors and come up with a figure.
Usually when they're issuing that, those yields are given by the issuer.
No. This yield is depends on the bids. Issuer, so not in government securities or any other securities, the issuer may give you some indication. This is the price range that you are looking for, but it's just an indication. The final figure will be decided by the investors based on their analysis and their views and their willingness to take the risk. And based on that, they will submit their bids. Based on the bids, the final price will be decided.
So then in the page number 18, we have to mention the answer in the currency, not just 45 million and rupees.
Yes, it should be rupees because we discuss it in rupee terms. Yes, 45 million rupees. Yes.
So, excuse me, the bids could be done by banks and corporates or through brokers?
I didn't get the first part.
The bids, how the bidding process happens?
So for government bonds, only primary dealers are allowed to bid. Primary dealers and EPF can bid directly. So when I say primary dealers, there are two types of primary dealers: primary dealer units of licensed commercial banks and primary dealer companies. So all those primary dealers, they can bid. They can submit bids to the public debt, but they may receive bids from their customers. So they collect all those things and submit to the public debt department. Not individuals or other investors or corporates can directly submit their bids to the primary auction in the government bonds. But in other bonds, debentures, then yes, you can submit your bid to the book runner.
It means that in between that banks or primary dealers keeping a margin when they are selling to their customers, no?
Yes, they will keep it, but two things. But say I submit a bid, says 7% to the primary dealer. If the auction weighted average is 7%, then the primary dealer should be able to deliver me. If say he wants to keep a margin and he bids it at 7.1, he won't get any allocation. What would happen? So all those things have to be considered by primary dealers. Depending on the volumes, they yes.
Otherwise, whatever you that means banks is having existing stocks, then he can deliver it, no?
You won't have existing stock because this is a new issue, primary.
If it is a new issue, yes.
Yes. If it is a existing issue, it's a secondary market thing. Then the bank can quote whatever the price to the customer. If customer agrees, customer will buy it.
Right. Okay.
The weighted average yield. Sorry. The weighted average.
Yes, go ahead.
The weighted average yield that is shown on the above issuance is after all the bids are closed, is it?
Yes. No, no, sorry, not up, not all the bids. Based depending on the accepted bids.
Accepted bids, yeah. So as you said, they'll now central bank, the people who are governing this will be giving an indicative price or something that you said.
Yes, I think for even for the government bonds, in the press release, I think they indicate something. This is
okay. So based on that, the PD, how a PD might act is he might get certain bids from their clients, and based on their individual company discretion, they'll consider that and their own company whatever cash flows or so forth, and only go for the bid, no?
Yes. So that's what I wanted to tell. So primary dealers, they have some sort of regulations. So they have to submit minimum amount of bids. So therefore, to fulfill that, if they have enough volumes from customers, they might submit it as it is. I don't know. Without keeping margin, because then at least they fulfill the requirement. But if they have their own money, they can be based on their different briefs. But two things. Say if the customer is asking 7%, and you think today's auction you can get it at 7.2,
yeah,
you won't submit 7%. You will submit at least 7.10.
Yeah.
Then you get it at 7.10 and pass it to customer at 7. That's it. So all those things.
Even that goes the other way also. No, customer asks for 8, but the auction goes for 7.5. Still, there'll be a problem. No?
Then you can say to the customer, your bid is not success.
But each PD is obliged to take some amount of bids for each issuance.
Yes, not to take bid.
Yeah, bid. Okay, only to bid. So it's up to central bank discretion.
There's a way of calculating. So what is the amount of bids submitted and the success rate? There's a process.
Okay.
To assess that whether the primary dealer has acted on good faith.
Yes, go ahead. Okay.
No, this is where sometime back there were some concerns, I guess, before 2-3 years.
Yes.
So in this case, that central bank announcement, this is after the auction. No, they have mentioned that maximum yield rate for acceptance is 7.07 for the number 1. And for the number 2, they have mentioned 7.98 for the minimum yield rate for the acceptance.
So sorry, I didn't get that.
No, when this auction published by the central bank, in that sheet they have mentioned minimum yield rate for acceptance is 7.07 for the number 1 issuer.
7.07.
Yes, for the second one that is 7.98.
Minimum.
What does it mean? Yes, minimum. Yes, sorry, maximum yield rate for acceptance.
That's the indication.
Yes,
asking not to be beyond that.
Right.
That's why this is comes close to 7.97 and others comes 7.0. It's at the ceiling. That's the price
And
indication given by the issuer.
Right.
They are not willing to buy at more than 7.98 for the second one. That's what you mentioned. 7.98. Yes. That's the maximum they are ready to accept.
In other words, maximum offer.
Yeah. Sorry?
In other words, from central bank's perspective, the maximum offer.
Yes, you can say yes. Yes.
I think that's why in second case, that amount accepted is lesser than the offer amount because that amount, that yield rate received is much higher than the central bank published rate. No?
Yes, yes.
So usually the primary dealer should bid with the rate, right?
Yes, yes. Amount and the yield, they have to be submit.
Depending on those rates, the bank, central bank decide to whom to give.
Yes, there's a process.
Okay.
So in bank's point of view, who will decide that rate? Is it ALCO or?
I don't think it probably would be because for the bank there's a primary dealer unit.
Yes.
Separate that unit.
Yes.
They may get some indication from Treasury and ALCO, but it's considered as a separate unit in the bank.
Right. Okay.
Yes. Okay, shall we stop then?